Hi, Coach Jeff here today to talk about the 2023 housing market forecast that I put together. Before we get started, however, if you like this video, smash that like button. Do me a favor, subscribe. It always helps, and it allows us to bring you guys the best content available. So let's get right into the 2023 market predictions, where I think we're going to be, and a lot of them are actually things that are in the process of happening right now. In some cases, they've literally already happened. But let's start down from the top. First thing is that sales are down. Now, for 9 months in a row, as we record this, it is late November of 2022. For the last 9 months in a row, the number of units sold in the U.S. has been down every month. That trend's going to continue, I believe, until the summertime or so of next year, in which case it will level out and then start rising again. And these are my predictions. This is based on no scientific formula other than my observations that I see out there, talking to investors, coaching investors, nationwide, that type of thing. But you're going to see the number of units continue to decrease. And there are several reasons for that. The primary reason being the cost of money, the higher interest rates, and the fact that a lot of first-time home buyers can no longer afford these things. And that's my second point, is mortgage rates are going to continue to go up. Currently, they're around 7%. We're expecting a Fed increase coming up here, I believe, next week. Expect another 50 basis points increase in the Fed funds overnight rate. And you're going to see that reflect in the future pricing for mortgages. They could reach as high as 8 or 9% by this time next year. And there is a possibility that the Fed will start moderating their increases. In other words, we've had 3 or 4 75 basis points increases in a row. And I think they're going to be doing between 50 basis points and 75 here next week. And then you may see numbers start to drop in the future. You may start to see 0.25% interest rates, 25 basis points, that type of thing, increases in future. And so as those things moderate, you're going to see the mortgage rates tend to flatten out. They're far too high for the market that we've got today, the prices we've got today, but we can't get the prices low enough on houses, I don't believe, to offset the fact that we've got high interest costs. Now, there's a lot of ways around it. We're going to talk about that in a second, but mortgage rates are going to be up. That's the second thing that I'm predicting for 2023. The third thing is prices will continue to drop. Now, prices have dropped about 10% so far since the peak that we had maybe in March or April of this year to where we are today. Some markets have dropped very little, like 1%, 2%. Others have dropped 15%. I think by the time this thing is done, it could take up to 20% off of the market. I don't think it's going to be much more than that. I think it's probably going to be in the range of 10 to 20% decrease. There are expectations out there that it could go higher. In other words, a deeper dive, more prices drop. And there, of course, are people who are still saying that the prices are going up. Those guys are, in my opinion, smoking crack. They don't know what they're talking about. They're not looking at real world numbers. They're not talking to real sellers, which is something that we do. And when you do that, you find out that there are more motivated sellers out there than there have been in the last 4 or 5 years, in my opinion. And that's the next point. Besides prices dropping and then flattening out at some point when we get 10 to 20% off the market price. And I should back up and tell you a little bit about how that works. From 2007 to 2012, the market dropped. It reached its peak in 7 and it dropped and dropped and kept dropping. Now, of course, different circumstances then. We had a lot of issues with regard to mortgages. People were writing mortgages, or companies were writing mortgages to people who probably didn't deserve to have the mortgage. They couldn't qualify or really pay for those homes, especially when rates ratcheted up because of adjustable rate mortgages. And so that created its own problem, and it delayed that period of time when prices fell. It also put a lot of properties on the market at one time, and that further exacerbated the price drop. And we got in some markets down to 40% off the previous high of 7 to 12. But it took 5 years to get down that low, and then it was flat for another couple of years, 12 to 14, and then it started raising from 14 to 22. It peaked earlier this year, as we've talked about. I don't think we're going to have a 5-year drop. My opinion is it's going to be less than 2 years. It could be as little as a year and a half, but it's someplace, in my opinion, between 18 and 24 months where you're going to see price pressures continue to drop. And there's really no reason for prices to drop, in my opinion. I think they're properly priced. The money's too expensive. That's the bottom line. The mortgages are too expensive. So what we've got is more sellers coming on the market like to sell their houses, but there are fewer buyers that can afford those expensive mortgages, the 7-8% mortgages. So there are more buyers and more sellers. There's a lot more buyers because every day that goes by when there's less people who can actually buy a house because of limited supply or too high a mortgage, which is what we've got, you get more buyers built up. You get this elastic built up demand for more people to buy houses. So more sellers getting themselves into trouble right now and continuing into next year, more buyers continuing to come to the table wanting to buy but can't buy. And, there's an old adage out there that says, if you've got a problem that can be fixed by money, can be solved by money, you don't really have a problem. You just need to find the money. And that's really what we've got going on out here in the housing market, and we will for the next year, is there is a huge amount of demand for houses, and there's going to be a bigger amount of supply. And we should have a very robust market of properties trading back and forth. But the thing in between is this 7 or 8% mortgage rate. Now, there's a lot of ways around that. In creative real estate, that's the kind of thing that we teach. That is our bailiwick, transactional engineering, how to take a 7 or 8% mortgage rate and drop it down to something more affordable for most people. There are ways through interest rate buy downs and longer amortizations and bigger down payment assistance programs and things like that would allow this to go away. And that's why, in my opinion, one of the next things you're going to see in 2023 is more investor activity, especially in the seller finance portions of the marketplace out there. Investors have been a big part of the market going in the past. They've dropped recently, and now they are starting to come back, but more in the seller finance transactional engineer, because we have the knowledge base that, frankly, a lot of real estate agents and a lot of sellers don't have. And we can bridge the gap between a lot of buyers, a lot of sellers, and a lot of demand, but the interest rate we can fix. We can work around that by doing different things. So you're going to see more investor-friendly transactions. You're going to see investors more involved in things out there, and you're going to eventually see the volumes creep up in terms of numbers of houses sold, although I think it's going to be a year before you're going to start seeing those things happen. And the last thing is we've got excess cash in the marketplace. We actually have excess equity in houses that are out there, and we have excess cash in the marketplace. And by that, I mean there is an all-time record number of properties that have huge amounts of equity in there. And that is going to keep going for a long period of time, in my opinion. So we're going to keep on top of that. And I think you're going to see a lot of people take advantage of that equity. A lot of investors are going to be in play for that equity. A lot of sellers have the ability to discount their prices because of the equity. And you combine that with excess cash generally in the worldwide marketplace with no good place to get a return, and you're going to see people come up with solutions that are going to take that excess cash and put it to use solving this high demand and high supply issue where the two can't talk to each other. Somebody's going to be smart enough to figure this thing out, and that's what I think you're going to see happen in the next 12 months.